Reserve Bank of India truly did justice to its tag of a full-service central bank today. We went in for a monetary policy review, and yes, we did get a monetary policy review, which was mildly uneventful. But along with that, we got liquidity/yield management measures. We also got credit measures to try and spur flow of credit to the economy. Joining us to talk about the big picture on all of this is Neeraj Gambhir, President and Head of Treasury and Markets at Axis Bank. Neeraj, firstly, thank you so much for joining us today. It's great to have you back since you've joined this role. This is the first opportunity we've had to speak to you. Thanks so much.
Pleasure.
There's lots to talk about, and I'm not going to start with the rate decision or the monetary policy stance. But in many ways, today was a step away from conventional, or yet another step away from conventional policies to try and attack the core of the problem in the Indian economy, which is the cost of credit and the flow of credit. Is that the big picture?
That looks like to be the case. I think clearly their hands were a bit tied as far as the rate decision is concerned because of the way the inflation has played out over the last few months and the way inflation is likely to be over the next few months. So I think there is very little that they seem to be able to do at this point in time from a rate front, but clearly there is a lot that they have done with regard to making sure that the price of money goes down in the system as well as the availability of the credit to the economy actually improves substantially. So both the measures, I mean, I basically, it could be seen as some kind of a backdoor easing because the net effect is likely to be that there is going to be lower, rates, lower yields in the bond market, lower rates, and hopefully over a period of time, this should also translate into, somewhat lower deposit and lending rates.
All right, Neeraj, now on to the parts, the sum of parts, but individual parts that were announced today. I'm going to start with the LTRO, which is the Long Term Repo Operations. Firstly, am I correct in judging now, after what we heard from the governor, that both Operation Twist, which came after the December policy, and now Long Term Repo Operations are clearly yield management tools? They are not liquidity tools. This is the central bank diving into yield management.
Yes, I mean, if you asked that question in the post policy sort of analyst meet, the press conference, and it was basically said that this is not necessarily yield management, but it is more like making sure that there is a better transmission to the corporate bond market. It's a bit of a nomenclature to my mind. I think effectively what we're basically trying to say is that the term premium of money in the bond market, whether it's a government bond market or whether it's a corporate bond market, actually comes down and reflects the fact that there is a far more longer and sustained commitment to be accommodative as far as the liquidity is concerned and as far as the interest rate policy is concerned, and to make sure that the that is kind of getting factored in. I would say that the bond market in India has had to go through a somewhat of a difficult period in the recent past, particularly in the corporate bond side, where you saw a spate of defaults from AAA and AA rated entities, which caused a bit of a confidence crisis in the bond market, and that sort of led to a far wider spreads for, let's say, AA or AA plus rated bonds. Now, with these measures, if we see those spreads tightening, then I think these measures would have sort of achieved their objective, which is basically to lower the cost of funding for, let's say, not the AAA, not the PSU, but AA or AA plus rated entities.
Okay, so I'll come back to Operation Twist in a minute, but since LTRO is what was announced today, can you help us understand how this will actually play out through the market?
So we need to see the detail because we will wait for the final circulars to be issued for all these changes in the liquidity management framework that Reserve Bank has brought in. But at this point in time, the understanding is that they will be conducting auctions. I think February 15th is the date in which they will invite bids for banks to borrow money for a longer period of time, say 1 year, 2 year, 3 year, against the collateral of government securities. This money is going to be available at 5.15%, which is the which is the policy rate. So, so the way it sort of incentivizes holding of longer-term bonds is that, let's say you have a 2-year or a 3-year bond which is yielding you, say, about 5.75 or 5.90. You put it in this repo and you get longer-term funding. So on a matched basis, you have a spread which is locked in, and that spread sort of encourages you to buy more of these short-dated bonds. The only caveat here is that there is a limitation to how much amount they are willing to inject by way of this, and that's 1 lakh crore. So that's going to put some kind of a constraint on how much bond bids can be there in the market. But effectively, this should help bring down the shorter end of the government bond yield curve, and it should basically make sure that there is more incentive to buy corporate paper in those maturities.
So the rate signal it sends is that perhaps there is no reason for rates in the 1-year, 3-year bucket to be very much above repo, is it not? Is that not the rate signal?
Yeah. So it's basically taking out the term premium, right? Yeah. It's basically compressing the term premium. See, the thing is that we normally think of a policy intervention in the rate space as changing the overnight rate, right?
Yeah.
But the issue here is not the overnight rate. The overnight rate is already quite low. I mean, there is obviously some more scope for the policy to be reduced, policy rates to be reduced. The issue is that the term premium in the market is fairly high at this point in time. The market believes that these rates are not sustainable for longer, and there is more demand for what we basically say is the risk premium for the tenor. And that's what the central bank is trying to act upon. In that sense, these interventions, whether you call it LTRO or whether you look at Operation Twist, they're basically taking a leaf out of what the developed economy central banks did in the aftermath of global financial crisis. I think almost everyone sort of started doing some kind of the other operation to bring down the long-term term premium in the market.
That's the term premium, which allows me to bring back Operation Twist. I was surprised to hear the governor say that it is targeted at corporate bond yields. I would have fully understood if the explanation was term premium, but corporate bond yields are reflecting a credit risk, which may be justified, right?
So the issue here is that we, given the fact that for most of the corporates, the borrowing is somewhere between 5 to 10 year segments. I think there is a lot of PSUs who actually borrow money in the 10-year segment, a lot of corporates who borrow money in 3 to 5 year segment. And the market looks at what is the rate on government bonds and sort of applies a spread to it. When you do an Operation Twist, you basically reduce the term premium for the government bond market, and you make the owning of the corporate bonds relatively more attractive. So I think what he was trying to differentiate between was that, are we doing this to help the government bring down its borrowing cost, or are we doing this to make sure that whatever rate actions we have taken, they are transmitted to the other parts of the markets as well. And there is some benefit which is coming to the corporate borrowers as well through the lowering of corporate bond yields. I think the objective in their mind seems to be not benefiting government's funding cost, but benefiting corporate's funding cost.
Okay, understood. A couple of more questions in this regard. So, we've had now 3 liquidity tools introduced into the RBI's toolkit. We had the forex swaps. We did a few rounds of those. Then we did Operation Twist. Now we've done LTRO, although they are more yield management than liquidity. But can you give us a sense of what do you think the RBI's preference is in the current environment? Which of those will they use, or will they keep toggling between them depending on the situation?
I think, there is going to be obviously a dynamic play here depending upon a given point in time what the situation looks like. But at this point in time, I think the major change that is there in my mind is the fact that the LAF operations, the way they have been tweaked is that the reverse repo, which was available earlier on a daily basis on a fixed rate basis, is going to be done away with. And now you're going to have that reverse repo only available on a fortnightly basis at the beginning of the fortnight, coinciding with the CRR maintenance cycle. What this is going to do is basically anchor down the overnight rate to 4.90, which is the floor for LAF. and that's going to have a bigger impact on the short-term rates in the market. The other tools, which is basically LTRO, that will probably bring down the term premium in 1 year, 2 year, 3 year segment. I don't see at this point in time the FX swap tool getting used, because that was an experiment that they did at that point in time. But I think the focus is much more on domestic bond market rather than the FX market at this point in time.
Sure. Neeraj, I don't want to get into too much detail about the liquidity, the new liquidity framework. You mentioned one part of it. The other part of it is that they seem to have removed any quantitative, restrictions or limitations on how much surplus or deficit they will maintain. I think probably good in this current scenario because it allows them to keep the market well flushed with liquidity.
True. I mean, I think there was, those quantitative restrictions were in a way infructuous, because they're, if you look at throughout the episodes of deficit in the system versus the surplus in the system, I think invariably the liquidity deficits and the surpluses have been far higher than what they, initially said, that 1% of ADTR it should be. So it wasn't, they were not able to kind of keep it in that range. So it was in a way infructuous. So this is just kind of stating the obvious, I would say.
Okay. A bigger question on this before I move into pure monetary policy. I think the question I was trying to ask in the press conference, I couldn't articulate it, is that there is one objective which the Monetary Policy Committee is looking at, which is inflation targeting now. And the tool that they use for that is repo. And the decision there is that given the inflation picture, we are not in a position to reduce repo rate. Yet, the RBI on the side is using all of these other tools to keep easing monetary policy. Are those two not in conflict?
Well, on the face of it, might feel like that, while the headline interest rates are not getting reduced, but there are other things which are being done to make sure that there is a pass-through of the previous rate cuts in the. I guess you could say that the MPC is worried about the fact that headline inflation is headed higher, but it doesn't think that this is a very persistent phenomena. Therefore, it doesn't want to be seen as cutting the rates in a time when the headline interest rates are higher, but it still maintains its accommodative stance. It still wants to be pro-growth in that sense, and it still wants to encourage the growth by doing whatever else is possible. And it is this whatever else which the Reserve Bank is carrying out through its administrative measures and regulatory measures. So I don't necessarily see, given the fact that they have very clearly articulated a pro-growth stance and a very clear accommodative stance, at this stage it doesn't feel like that they are in conflict with each other. But at some point in time, if the MPC were to decide to become, and this is purely a hypothetical situation, that if they were to decide to become more concerned around the headline inflation and would want to sort of tighten up the liquidity, would Reserve Bank would still be doing that? That's an open question.
Fair enough. That's well explained. Neeraj, just onto a couple of other aspects, pure monetary policy. So interest rates at about 5.15, you think, given their language, do you still see scope? I know they're accommodative, but do you see scope for cuts on the repo rate side?
I think it depends upon what is your forward forecast of inflation. If you look at H2, it still feels like, and given the forecast that Reserve Bank has put out, it still feels like that you will be somewhere in the 3% to 4% handle as far as the headline inflation is concerned. We know that the core inflation is very benign even at this point in time. It's sub 4%. So 5.15% and the inflation projection of H2 of next year of about 3.5% to 4%. I think it still potentially leaves a room for you to cut rates by 25 to 50 basis points and still maintain a positive real interest rates. In fact, many people would argue that given the growth situation that we are in, it's a multi-year low in terms of GDP growth. Why retain a positive real interest rate bias? I think that's a discussion for another day. But my argument would be that assuming that the inflation plays out as they have forecasted, and we are going to be sub 4%, then cutting rates by 25 to 50 basis points still gives them a lot of headroom to sort of support growth.
Will global factors start to come into play once we see the impact of coronavirus, etc., play out on the global economy?
I think so. I think the coronavirus element seems to be pretty significant and serious. I think a lot of comparisons are being drawn with SARS and what happened during that period and what was the impact on particularly the growth of Asian economies. This time around, the focus is much more on China, and we know that China has downward linkages with a lot of Asian economies. So this could be an indirect effect on many Asian economies if the Chinese growth were to come down by about 2% over the next 2 quarters. So that is going to be a big factor as far as the both emerging market and DM central banks are concerned in terms of their forward policy. We typically tend to have far lesser correlation with what happens with China, but whether we will be totally immune is hard to say. I think there will be some knock-on effect on the sentiment as well as on the trade that could actually end up impacting us as well. So I would think that while this has not been a direct reason for central bank to be so dovish, but somewhere along the line this has played some part.
Sure. Neeraj, the Monetary Policy Committee statement essentially seemed to take some comfort from the fact that the government is not doing any additional borrowings, even though the fiscal deficit was higher. That borrowing is being pushed to the NSSF. But yes, there's comfort on the bond market front, but that NSSF is a big problem for the banks. So, and we're a bank-driven economy. So I know we're all thrilled that the bond market is not getting hit, but the banks will see even more stickiness on deposit rates.
Yeah, so I think that's been one reason why the deposit rates in the system have not fallen very rapidly. For many banks, that's a real concern. And I think in general, I think if we want much better transmission in the market, we want far more efficient sort of transmission of monetary policy impulses across the spectrum. I think it's a good idea for us to have all rates, whether they are sort of rates on government saving schemes or whether they are rates on the banking sector, deposits, or let's say the rates on things like pension fund and provident fund schemes to be aligned to the market. I think that's the core principle, and it feels like that at this point in time there is not adequate alignment. And if that alignment were to happen, you would definitely see a far better transmission across the economy.
Some of these other credit measures they've announced today, CRR exemption on incremental lending, you deduct that from NDTL, some SME restructuring, etc. Do you see them having major impact?
I think it's a clear-cut sort of push to make sure that there is good flow of credit to some of the important sectors of the economy. Some of these sectors, for example, mortgages. I think it can have a significant multiplier and knock-on effect in terms of if there is big sort of pickup in mortgages and hence the real estate industry does better, it can have a significant multiplier impact. Even other consumer loans can actually push up some of the consumption demand. And there is obviously a focus towards medium and small enterprises, which are the backbone of our real economy. So I think all of this is basically to encourage banks to do some bit more lending. And given the fact that CRR is a dead weight cost, if you allow that benefit to the banking system, you're basically making it easier for banks to pass on some of the benefits of low rates to these segments of the economy. I think that's as close to a push that central bank can give. The other thing, obviously, that they could have done is on the risk weights, but I think they felt that risk weights, as someone asked in that conference, the risk weights seem like not the right way to go right now, and hence they chose to give this dispensation.
All right, Neeraj, last question, more budget, because we didn't get an answer from the governor on this. But how do you think this plan to open up specified government securities fully to FPIs is going to work out? Do you suspect they'll issue some new securities? Will they open up the 10-year, which is the most liquid? Interesting to watch.
I think we have probably the same set of questions that you have, and there is not enough answers. We are still looking for, answers to some of these questions, and the governor said that this is a work in progress. So hopefully at some point in time, the market will get that clarity on what's the modus operandi as far as this piece is concerned. This is obviously a step towards making sure that we get more steady, less volatile debt capital flows into this country, and that are not seen as fair weather friend flows. And the market has been asking for inclusion in the indices. Recently, China has done it. In fact, they've completely abolished the quota system for foreign portfolio investments in the bond market. So there is obviously a long way to go for us on this, and probably this will take some bit of a work by both the policymakers and the regulators. But hopefully, we will get some bit of clarity on this going forward. And whichever path they go by, I think it's going to be positive from the bond market perspective.
All right, I'll leave it at that. Neeraj Gambhir, thank you so much for taking all of our questions. Thanks for watching BloombergQuint as well. We've got a lot on the policy and the measures announced by the RBI app on the website. Do go there and check them out. Thanks.